So our guest today is a serial entrepreneur and businessman who was probably best known for being the founder of the ridiculously popular Reddit page, WallStreetBets. Jamie Rogozinski, thank you for being a guest on Valuetainment. Let's talk money.
All we talk is money. All we talk is money. All we talk is money. All we talk is money.
Hi, thanks a lot for having me here, Adam.
How you doing, man? What's up?
Doing very well. A lot of things are going up. A lot of activity over the past couple of weeks and couple of months. And definitely more interesting than it was last year, that's for sure.
So you're in Mexico City now, yeah?
Yeah, I am. I've been living here for about 7 years now. When I moved down here, I met my beautiful wife, and now I have kids here. So for the foreseeable future, I'm happy here, and really, I don't know, just kind of go where the wind takes me. I stopped trying to predict what I'm going to do in the future, so I just try to live in the moment. And for the time being, I'm really happy.
So you've got a very chill personality. Is that always been you, or is that like, dude, it was just Cinco de Mayo down here in Mexico, and I'm a little hungover, or what's your vibe?
I tend to be more of a low-key personality. I definitely have my moments of people that have known me throughout the years, and especially in the college years and the parties and things of that nature. I have my wild side to me, but I tend to be categorized as being more of a serious, kind of thoughtful guy.
I don't think I've ever been called a serious, thoughtful guy. So this is like a yin-yang guy right here. I'm a little more animated, like to have fun, but I respect people like you who are just great free thinkers and thoughtful and serious. So I think we're going to have a great conversation.
I'm looking forward to it.
So correct me if I'm wrong. You founded WallStreetBets 2012. Prior to the whole GameStop, WallStreetBets, hedge fund melee fiasco, I think you were hovering around 2 million subscribers at that point. Now, since then, you've blown up. I think you just surpassed 10 million subscribers, or degenerates, as they like to be called. So correct me if I'm wrong. The story goes that you were looking for essentially different ways to invest, and all the forums that you were going on Reddit were pretty dull, uninteresting, and people were telling you things like, no, that's too risky, or you can't pick individual stocks, don't try to pick them, you're never going to win. So you decided to create this forum, WallStreetBets, almost 10 years ago. And you basically said, look, this is a place where risk will be encouraged. Safety's out the window. It's gonna, we're going to live that YOLO lifestyle, which is ironic because I don't feel that vibe from you. And you basically said that investing is going to be a little bit more like gambling in a casino, hence the YOLO model. Do I have that right?
You do have that right. And, but the one part that I'm not sure you captured properly is you can have both at the same time. You can have the YOLO irresponsible gambler and at the same time have the responsible diversifying, inflation combating, whatever, portfolios. And I was with both. When I started WallStreetBets, I had a good job that was paying me well. And I had my retirement plan through my employer where they're matching my 401k and doing all that stuff. And that's my nest egg for my retirement. And then, but I also had money left over that I decided to put to work. I said, okay, the stock market's this crazy thing. We're fresh off the boat with the 2008 financial crisis. And so I'm like, all right, well, it's a lot of crazy volatility going on. Let's see if we can put this money to work. And if I lose it, I lose it. I have my retirement already. I'll be all right. And if I make money, then that'll be great. And I think that's that probably characterized the majority of the people that go on WallStreetBets. They take whatever money they can afford to lose, and they say, okay, let's YOLO. Let's see what we can do. All or nothing bet with these leveraged crazy lottery tickets. Obviously, there are some people that take irresponsible approach to this, but the grand majority of it are like, oh, shoot, I lost $500. I'll wait for my next paycheck. I'll refill and try again.
So let's talk about having both, right? Because I'm right there with you, bro. Like during the days, I'm very sound. Whether it's my whole lifestyle is save that money. That's my catchphrase. That's the slogan of my show. I max out my 401k every year. I used to have a Roth IRA when I used to qualify. I used to contribute to that. I've saved. I've invested index funds, mutual funds, and then I've taken 10% of my portfolio and I've put it into certain crypto, certain businesses, certain, riskier strategies. So let's talk about asset allocation in both. So you're not necessarily recommending, dude, go all in on Dogecoin 100%. You're basically saying, look, I have my 401k, I have my fallback plan, I have my retirement accounts, and then I'll take a certain percentage of my portfolio and go for the moon. Did I sum that up?
Yeah, I mean, absolutely. You'll know better than everyone that the risk and reward go hand in hand. So if you want to make a lot of money, you have to be willing to lose a lot of money. So
Yeah.
you take whatever you can afford. Take whatever you need for the long term for your planning, the responsible approach to it, and you have that kind of strategy. And then you have money left over, or if you feel like taking a little bit more risk, then you can throw it towards the Dogecoins or whatever, these lottery tickets that can make a lot of money. And I see this as a double component that's kind of cool. The first one is, let's take a bet and let's hope that we make more money. And let's hope that we make a lot of money, and we're prepared to lose whatever we put into the bet, which is 100%. But on the other side, a lot of people, once they've placed that bet, you'll notice that they decide to read up on whatever the heck they just invested in, right?
Rather than doing it the other way around, yeah?
And so what is this Tesla thing about, right? Or what is this? Oh, okay, well, they're announcing the quarterly earnings in a week. Okay, I'm going to have to watch that. What is it, quarterly earnings mean? Oh, okay, they're announcing, discounted cash flows and sales and projections and whatever. And next thing you know, they're looking at the Fed interest rate decision because that affects it, whatever they're doing. And then next thing you know, they're getting themselves educated on this. And if they try to buy stock options, which is a whole other beast, right? They start to learn about that. And they're very complicated. I mean, they can be simple, but they can also be really complicated. So that encourages people and it empowers people to really take control over everything. And perhaps they can take some of that knowledge they learned, and probably, more people lose money than they do make it. We're not going to, those statistics are out there, but they can take some of that knowledge and put it towards a responsible one, which is, okay, well, I've seen the tendencies. It seems like tech is really outpacing the other stuff. Maybe with my 401k, I'm going to change from the S&P and put some more towards the NASDAQ, which, and make adjustments there based off of their experience that they learned. So, I think there's benefits to outside of just the making or losing money.
Are you basically saying that for the casual person or retail investor, that they need to have some skin in the game before they want to actually care? Meaning, once I put my $500 or $1,000 or $10,000, then I'll start reading up on what the hell I just invested in, rather than, all right, let me do my research. Let me actually understand what I'm doing. Boom, now I'm going to put my 5, 10 G's in it. What do you think about that different approach?
Absolutely. I mean, I think that's what's happening, right? Because right now the markets are so accessible for people. You can just download an app on your phone, trade it for no commissions. You can do fractional share price, no minimum anything. Like, barriers of entry don't exist anymore, and they used to. And
what doesn't exist? What'd you say?
The barriers of entry.
Gotcha. Totally agree.
It used to be time consuming. You need more money. You need more paperwork. You need whatever. Instantly, within 2 minutes, you can start trading with a ton of these brokers. And so people can jump into it, and they can they can figure it out. They can learn it. I think that they realize that things are risky, and I don't know. It's extremely valuable, I think, in people's long term.
Let's talk about those barriers to entry, because I grew up. Are you 40 yet? How old are you?
I'm 39.
39? When are you turning 40?
October.
All right. Well, if I don't talk to you before then, happy birthday, bro. You're looking great for 40.
Thank you.
So we grew up, in the 80s watching the movie Wall Street, right? And Michael Douglas, Greed is Good. And then obviously that turned into Boiler Room by year 2000, which turned into The Wolf of Wall Street. We've seen all these movies, Gordon Gekko, Coffee's for Closers, everything that we've kind of seen. And the barrier to entry, to my question to that, you used to have a stockbroker and pick up your, handheld phone, cord phone, and actually make trades that way, and have a guy on Wall Street or a stock guy that you were investing in, and they made commissions on this. So there was literally a barrier to entry. You couldn't make trades on a whim. To your point, the barrier to entry has been completely eliminated, right? You can go on your Robinhood app or Fidelity website or TD Ameritrade, any of these things. Do you think that barrier to entry is a good thing? Do you think it's a bad thing? Is it a risky thing? Is there reward there? Talk about the barrier to entry.
When I first traded stocks, it was like in 2006 or 7-ish. I remember because Google was going to do their IPO, and I really liked Google, and so trying to figure out how to buy these stocks, and the brokerage accounts were just really fancy terms, and you have to go through so I called my bank up. They're like, yeah, we have a brokerage service, and the Wells Fargo now. They might have been called something else back then. And they're like, yeah, you can just activate it, and then you need to transfer the funds from your account into this other one. It'll take a week, and they have to fill out these things and whatever. So I would do that, and then all of a sudden I would have the money, and I would want to buy. Well, it was going for $300 a share back then. So if I wanted to put $1,000 into this thing, I had to pay $30 commission to buy it, and then $30 commission to sell it off of $1,000. That's prohibitively high. Plus the execution of it as well. The interface, like you can't do like limit orders, or you can't kind of set some logic. You don't necessarily get the best prices. Nowadays, like I said, you download an app. There's dozens of them, including the brokers themselves. They've all had to adjust to this competitive environment. You download an app, you fund it instantly, you fill out just a couple of questions about yourself, and you're able to trade stocks for free. You're able to track fractions of stocks. You're able to trade stock options if you want. A lot of them are involving cryptocurrencies or crypto coins into this. So it's much easier. The cost of experimentation has gone down to pretty much nothing. And I believe that's a wonderful thing, because I believe it's good for two approaches. One, it's good for the people, right? Like the fact that you can learn about the stock market, learn about finances, get skin in the game, actually feel what it is to trade these things. And by the way, that itself is a really valuable lesson, because even if you learn in the textbook what it is before you invest in something and you took your classes and whatever it is, when you put money into something changes, even if you went from doing it on a simulator to real life. And I've seen this from a ton of people that said, I was told to buy Bitcoin back when it was whatever, and if only I'd done what I was told, I would literally have $25 million today and live with this. And my response to that is like, no, you wouldn't, because you would have sold it if you bought it at 70. You will have sold it if you're lucky at like $300.
Yeah,
because you would have said this is as high as it goes. You're not going to wait for it to hit $60,000, right? Like it takes people luck, right? They forgot their keys to the wallet, they couldn't sell it, or it takes people that have already done this before, or it potentially takes someone that has incredible discipline, incredible foresight, and incredible tolerance for risk. Because remember, if you have something that's already worth $1 million, do you take it off the table, or do you let it ride to 25? Because you have $1 million. You can't tell me in hindsight, with hindsight you can, but without the hindsight benefit, you can't tell me that you wouldn't take the $1 million and run. So that's super valuable for people. They can all experience it. They can all live it. They can all learn it, and they can all make mistakes or whatever. And I also think it's really good for the economy in general. The market serves a really powerful purposes in the economy in many ways. Probably the most powerful way is the concept of price discovery, right? Buyers and sellers agreeing on a price and then trading at that price. And that price signals things to the economy and to the world and blah, blah, blah. Having more participants is automatically a good thing for this, because that price that's discovered is more valid. There's a lot of people that say manipulation of the stock market. If you have more people involved with it, you make it harder for anyone to play with it. And I think that's better for society.
I agree with that response. And I think what you're saying is to the effect of the $1 million example. And no, you wouldn't, because you would have sold it. That's essentially the whole concept of buy and hodl, right? You hear that in the crypto world, but the buy and hold strategy has been a thing for a while. So people always ask me like, hey, Adam, like, what's your investing strategy? Like, I don't really necessarily have a strategy. I just max out my 401k every year, max out as much as I can put in my Roth IRA. Any additional funds I'm putting into a mutual fund or an index fund, or I'm buying crypto and I'm just not touching it. I'm just, if I don't want, I look at investment as decade trading, not day trading, right? So is that essentially kind of where you're going with that methodology when it comes to investing? Is buy and hold, buy and hodl? Do you have a different perspective? What are your thoughts?
Yeah, if you want to invest, which is to grow your money responsibly and have a long-term time horizon, then absolutely. Like with Bitcoin in specific, it wasn't quite, now it's not the same, but back in the day when it was trading at $70, it wasn't quite the same thing because the entire thing was really new. The regulation didn't exist, but it was about to. Things could have fallen really easily, and so these assets weren't quite established back then. Now it's a currency. Now it's established. Now it's integrated with a ton of stuff. So the risks that existed back then no longer. So if you had $1 million worth of Doge right now, for example, like that's kind of the same way that I would feel about it, because Doge, we don't know what's going to happen to it, right? There's a lot of solid arguments as to why it's not worth what it's worth, but it could go really high up before it goes back down. Who knows? So with crypto, with Bitcoin in specific back in the day, it was very risky to do it. But to answer your question about investing, absolutely. Look, you put in your money every month or every 6 months, however long it is it's doing. Guess what? The stocks are going up, and then you get a 2008 crash or a 2000 crash or a flash crash, whatever. Then you wait a couple months. In 2008's example, you wait a couple of years. In 2020's example, you wait like a couple of weeks.
Right.
And you just keep putting that money in, and then you make that money back. And by continuing to put the money when the prices fall, you average your costs down, and your overall what do you call it? I think your gains are going to be more attractive. So you do that responsibly. It's like a savings account that just continuously, at the very least, keeps up with the rate of inflation. On top of that, you get your little dividends, you get whatever it is, but not having to try and pick it. I've seen statistics of people that say don't try to time the market, because if you take, for example, an average year where the S&P was up 10%, they say this year, obviously there were days it went up 2%, 3% down, whatever. If you were not in the market on 5 specific days of this entire year, you would not have made any money, right? Because on this day it went up 5%, on this day it went up 10%, especially last year in coronavirus, we saw crazy stuff happen there. But if you're away from your computer that day, you're going to miss out on that 10% that you were going to get. So trying to time the market has been proven that is difficult. There obviously are people that do day trade and they have strategies that are profitable and they can time the market based off of really statistics, and that works for them. But if you're investing and you have a job and you don't feel like getting into these things and being glued to your phone all day long, then absolutely, just every month put your money in there.
I think what if I can sum up what you're saying is, it's time in the market, not trying to time the market, right? And it's, to your other point, dollar cost averaging, whether the market's at 28,000 or 30,000 or 32, or it goes down to 25, just continually putting your money in the market, time in the market, not trying to time the market, if I can sum up essentially where you were going with that.
Yeah. And another one that really works is buy the dip, right? Like if the market really goes down really hard, you could buy a little bit more that time, right?
Buy the dip, baby.
Yeah.
I want to cover a couple of this. I want to circle back to some of your thoughts on crypto, Dogecoin, and all that. Let me just kind of veer a little direction, and we'll get back to that. All right, we're gonna buy the dip on this conversation. So let's buy low, and we'll get high on the. So just to kind of edify you, and so our audience understands, you're not just some fly-by-night dude who GameStop, WallStreetBets, and now I'm this guy doing interviews. Essentially, I think you got a degree in economics in University of Illinois, or Illinois Urbana-Champaign. Is that the main campus? What is that?
That's the main one.
Okay, so university, you're fighting Illini. There you go.
Yep, I am.
And I know you live in Mexico City now, but give us a little insight to your career, and maybe even start, like, who were you when you were in high school? Were you an economics guy, looking into the markets? High school, college, how'd you even end up in this world?
I'll start, I guess, with the high school. Like, I was really into tech. I started programming on my own. This is back in the 90s where the internet was starting to become prevalent, and I love tech. Gadgets that were coming out that really got a liking for programming and the type of thought process that creates. And I was also really entrepreneurial in spirit. Right? I had my little high school business where I would go fix people's computers or whatever, and it was cute because it gave me a chance to print my little business cards or whatever and feel official and write an invoice and whatnot. I went to college. When I went to school, I studied economics. I also studied computer engineering, and it was a kind of a double part thing, because I felt like I already had I didn't want to be a programmer, but I wanted to have a more in-depth knowledge of technology in general. and economics because it's an open field. It can be applied to a lot of different things, but I was just fascinated by the concepts behind things, right? The theory of things. It's not really practical to study economics. Can be, because once again, it molds a certain way of thinking. And in college, I continued my entrepreneurial spirit. I worked in an internship that was for entrepreneurs. We got to meet a lot of people, learn about sales, and actually, your bigger time businesses, they would help fund a business of yours. And over the summers, I would run a business that would, the first summer it was like $30,000, and the next summer it was like $200,000. So now we're talking about an actual business with all the different components. Out of college and through that experience and people that I know, I started another company. It was a tech company. This was out of Boston, and after with 5 partners around the world. And after a couple of years, we were acquired by a larger company that did the same thing. And when they bought it, I was like, all right, I hit the jackpot. I'm a millionaire. They've just given me this stack of papers that says, you're going to get the warrants with the strike price, the expiration dates of these particular stock options, whatever, right? Now, this paper feels really good because I did some calculations in my head, and I was like, wow, I'm a millionaire now. This is great. This is exactly what I wanted. And
what age were you at that point?
26.
26 years old, millionaire at that point.
On paper.
On paper. I'm with you.
This is the learning process, right? Like, I finally did it. And they gave me a little bit of a catch in the bank account. And so then as years went on, I stayed with that company for a couple more years integrating it. And as the years went on and I left that company, I was like, all right, so what do I do with these papers? How do I buy my car with it or my house? And it turns out that I didn't fully understand what I'd gotten myself involved with. And those pieces of paper, which are still sitting somewhere, are now worth nothing. So I didn't make any money from that, but that learning experience was invaluable, right? The company itself was a great growth opportunity. It started off from me just being the CEO and janitor of the company, right? To having an established business with hundreds of employees, with millions in revenue, with all sorts of fancy stats. And so I was like, all right, I went through that process. That's useful, but I don't know anything about finance. Clearly, I got my butt handed to me. So I started learning about finance. I started working in the financial services industry. Eventually working my way into an international bank, doing risk management and technology things. And that's around the time I started WallStreetBets, because then I realized, okay, this is how finance works. So let's give this thing another shot. But yeah, after I started working at this bank, a great opportunity came up here in Mexico for me to start another financial business, and I did. That was successful. Sold that off, and then started a consulting business. That was really good until we had a presidential change, and it's a boring story, so we had to close that one. But I'm just constantly on the look for these things, and always in technology, always in finance. And eventually I wrote a book about my perspective on finance. I called it WallStreetBets because I used a lot of anecdotes from the subreddit to explain concepts and trends that I outlined with regards to some of what we touched on, right? The barriers of entry getting reduced, having a certain mindset with millennials that experienced the financial crisis and graduated college with debt, no jobs, whatever. I kind of walked through the progression of where we're at and where we're going. And now I'm involved in all sorts of other really exciting things.
So if I could summarize that, you got this economics degree from University of Illinois, but your real knowledge came from the School of Hard Knocks of actually running a business. So my question to you is college worth it? Is college debt worth it? Or is it look, dude, you're going to learn so much more from actually running a business, being a millionaire on paper? Turns out it's worth nothing. Where did the real knowledge come from for you?
Look, if you're going to go to professional school to be a doctor, lawyer, whatever, there's no choice. You have to go to school because you're not going to learn that on your own. You might, but you're still not going to be able to practice. So if that's your dream, then without a doubt, you have to. And I don't think I've met any person, whether they've gone to an Ivy League or a community college, that has said after being in the real world that they apply what they learned in college. Maybe if you're an engineer, I'll add that one to the list of things because engineers do have to apply something.
It's a very specific set of skills.
Yeah. It's still kind of a professional degree. But the majority of the people is like, no, I learned this on the job. I learned sales on the job. I learned management on the job. If you're on the business side of things, if you're on the marketing part of the world or the creative part of the world, if you're, I don't know, an actor or a screenplay writer or a musician, all these things, you do it in the real life. So I don't think that's ever been an argument. At least I've never heard an argument, which is go to college so that you can learn your craft, and then when you start applying, you're like, oh, I took a class, whatever it is, psychology 102, and therefore I can sit at my desk and somehow do something about that. Is it worth it? I almost didn't graduate. Like I left college without one class that I needed to take with 3 credits. It was like some requirement about African study, something that was irrelevant to what I wanted to do. I was eager to start this business, and I left without graduating. And my mom pestered, and eventually I took an online class and got that degree, and it's sitting on her desk.
Those 3 outstanding credits, they were holding you back, bro.
Because she's the one that worked for it, so she gets to keep it.
Respect to mom.
For me, I did that. Maybe I did need it or didn't need it. It's difficult to get jobs in the corporate world without one. So, but not impossible. More and more you're seeing. I know people that work at Amazon that never went to college, and they have high-level programming jobs. I know that Tesla, their attitude around college. So I think people are starting to realize that you can accumulate knowledge on your own, and you can learn a lot more on your own. Programming, for example, I learned it even before college because my natural curiosity and I was driven. The tools are out there, the resources out there. There's so much stuff that you can do. So I'm not going to say yay or nay. It's just try to figure out what you want to do. What I can say without a doubt that I did get from college were contacts and connections that I did and do use to this day. Like that networking power was really effective. It's not exclusive to universities. You can do networking everywhere, anywhere. But if you're not naturally good at it, college fixes that for you. They force you to make friends, and you get around that. So that is a very valuable component.
Well said. And I think I agree with you on the networking side of things for sure. Especially even in high school. I went to public high school. I have connections there. And then I got a scholarship to a private high school, and the connections I made there were ridiculous. So I totally agree with you on the networking side of things, especially in college, especially those that might not be a great networker in real life. College will force you to do that. But I also agree with you that things have certainly changed. Opportunities have opened up for people without degrees. Speaking of things have changed, I believe that the book that you wrote was How Boomers Made the World's Biggest Casino for Millennials. Is that the name of the book?
That's correct. Yep.
That's the name of the book. So my question is this. So what's the biggest difference between the boomer generation and the millennial and Gen Z generation? You wrote a whole book about this. What's the takeaways that people should understand from that?
It's the mindset. It's the attitude. It's how we feel about things, right? When you have, so I have a set of 3-year-old kids, and they will never know what it's like to read a map to try and get to somebody's house, right? Like it's just the phone, the car, everywhere has and I can have this old person mentality where I say, well, but what if your battery runs out or they're sick, but that's not going to happen, right? That mentality in itself is boomer-esque.
You still got the boomer in you, bro.
You don't need to learn how to get to where you need to get to. You can get away with that. Same thing with, memorizing people's phone numbers, whatever it is. So it's really the mindset. The boomer mentality they have, and it's not necessarily bad, right? Like I guess there's a derogatory connotation with the boomer mentality, but no, they coexist. The millennial casino generation with the boomer. You have Warren Buffett making tons of money, and then you have millennials gambling with Doge making tons of money too. So and they barely really affect each other, at least because of the way that they approach it. But the boomers are like, all right, let's use the stock market for wealth creation, for being able to responsibly analyze a company and read their statements and listen to their calls and doing research and spending time to do these things, and slowly but surely make money. Millennials kind of get out of the starting gate with no money or less money or negative money. The demographics speak to themselves. They're getting married later, having fewer kids, own fewer houses. They're just not as well off as the Generation X or generation of the baby boomer generation. So right off the gate, they're having to kind of fend for themselves a little bit more. And they happen to get creative. They created, I'm a millennial too, created new economies around this. So this is going to be the gig economies. I'm going to do, just random little stuff for money, shared economies. I'll just drive a DoorDash for extra bucks, or I'll sell a picture that I made on an NFT on a crypto world, or I will make a video, and so and just trying to scramble and trying to hustle. And that mentality is, I'm not going to allow people to determine my future. I saw my parents lose their house or get unemployed. I had to move back with them. This is all because some big banks were playing around with something, and that shouldn't have affected me because I wasn't even in the stock market. So that mindset, it's more protective and more proactive of everyone's personal situation, and not just kind of trusting a system to push you through life. And this can even be translated to your question about college and things like that. It's like, not as necessary, right? Borders are also different. So when it comes to the book and it comes to the difference between boomers and millennials are going to say, boomers will look at each other and say, oh, I cannot believe Goldman Sachs or Lehman Brothers were playing around with these mortgage-backed securities like it was a casino. Shame on them. And they use that term casino like a bad thing. And millennials look at it and be like, somebody say casino? Where is it at? Because I'm not.
Point me in the right direction. Where's the casino?
Yeah, because they don't. 10 years ago you can do sports gambling, you can do any type of gambling. Poker was around for like this amount of time before that disappeared. But stock market gambling, perfectly allowed, and you can get the same type of returns, if not better. Right? The odds at this point can actually be better because there is no house that mathematically predetermines what the win rate's going to be. And so they flocked to it. They were like, did you call this a casino? You damn right I did. And I'm liking it. And this is exactly what it is. And so they wear that on their sleeves. They wear that on their chest, unapologetic about it, of saying, well, you guys were playing with it too. You just use really fancy words that we didn't know. Oh, these collateralized debt obligations with these credit defaults. Well, I like Tesla. It has a ludicrous button. And I can buy calls on it on my Robinhood, and I can, without understanding, by just saying that I think this stock's going to go up with a big green arrow, or if I think it's going to go down with a big red arrow. I don't care where the stock's going to go. Tell me which direction, and I can just pick a color-coded approach to this and make a lot of money or lose a lot of money. And I'm cool with losing that money, but I'm hoping that I make a lot of money. That's the difference of the two. And so now the boomers are kind of looking at the millennials going, you guys don't understand. You're going to get your butt handed to you. This isn't how it works. Look at their forward guidance for some, and it doesn't really matter. But they can, but it doesn't mean that one is right over the other. The boomers are still making the same amount of money the way they used to. They have their long-term time horizon. They continue valuating and finding the inefficiencies of book value with, the market value, blah, blah, blah. And in the same time, these guys are making memes. These millennials are making memes and posting them online, like talking about the moon or putting little dogs on it and joking about it. And they're making money too. And they are. Like at this point, we have a big enough sample size to know that there's a viable strategy to doing what they do.
Do you actually think they have a strategy, or they're just running on pure emotion and saying, fuck it, we're going to the moon, baby. Dogecoin to the moon. Is there actual strategy?
That is the strategy, right? So, it took me a while to realize that too. In fact, when Robinhood first came out, I did not like it, and I did not want it anywhere on WallStreetBets because I did have a bit more of a traditional. I was closer to the boomer mentality when I started learning, and that mentality is, well, Robinhood does these payment for order flows, and they're going to front run you, and so the little pennies you get are going to be less, and you don't even have bar charts if you do like to look at the prices, like figure out some technical analysis. They just have a little picture, and it's confetti, and it's just a little toy. And this is a serious place, and you should have good execution. And I want to have the fraction of a penny, whatever. But then over time, people prove that they don't care if they get stiffed on a few pennies, because you take like Keith Gill and made $50,000, turned that into $50 million. Like, I don't think he cares if somebody front run his calls that he bought onto this thing. Like,
is that the guy known as Roaring Kitty, aka Deep Fucking Value? Is that who you're talking about right there?
Yeah. Yeah,
is that your boy? Are you guys friends?
No, I haven't met him yet. Like, I'll probably want to reach out at some point to him, but I don't know who he is. But I'll close with this story. Before this GameStop happening, I had a guy from Canada. He was a director for a documentary, and he said, I want to make a documentary on WallStreetBets. Let's talk. And so we chatted a little bit, and he said, look, I'm your age, and I think I've been through the exact same experience you were. We were started with playing with stocks, hoping to do these things, then I got my ass handed to me. I had beginner's luck, so I had these dreams about how I was going to become a millionaire and could retire or whatever, but eventually I became humbled by the market. And so I took my time, I studied it. So now I get it. So you and I are both on the same page. Then he says, my wife, on the other hand, and this has been for 10 years. My wife, on the other hand, she started 2 years ago. And she said, I'm going to put some money into the stock market. And then she would come to me at night, honey, have you heard of this company Plug? I heard, this company, Virgin Galactic, whatever it is. And he's like, where are you getting these things from? No, that's not, these things are not even profitable. Oh, they're SPACs. Blah. And she goes, well, I think I'm going to invest in them. And she would make money. And he would roll his eyes and say, oh, honey, don't worry. We've all been through this, beginner's luck. Enjoy it while it's at it, blah, blah, blah. And so then she'd say, okay, whatever. And she'd keep coming back month after month, talking about these meme stocks, and he keeps rolling his eyes, and she keeps making a ton of money, right? So after a while, his little speech of you're going to lose eventually starts losing credit. After 2 years of this, he says, all right, you know what? I'm wrong. That's big enough to know that you're doing much better than I was, and you're just looking for meme stocks, and you're just going, the moon. So why don't I give you like $20,000, and you can invest that, and now you can actually make our household more wealthy. You can actually create an income strategy. And she said no. She said no, because it's not going to be as fun anymore. So here you have someone that's making a killing on a P&L and using the stock market to make money. And the husband says, all right, now let's do it more seriously so that they can actually change our lives. And she says no, because it takes the entertainment component out of it.
Wow.
And that to me is really fascinating and probably true. And she's wiser than I think that she realizes, because I think the moment that she plays with $20,000, that meme factor goes out the window and the nerves kick in, and then maybe that strategy of having fun no longer works.
Wow. So is investing supposed to be fun? Because I always say investing is not supposed to be fun. It's supposed to be like watching a tree grow or watching paint dry, compound interest, good things take time, sort of the Warren Buffett approach. If you want fun, hit the club, bro. If you want to get excited about your career. But it would seem like that thought process is the exact opposite in that strategy. It's like, if I'm having fun and I'm making money, that's kind of the whole concept here. Is that kind of where you were going with that?
It is, and it can still be boring. If you want to talk about your 401k or your Roth IRA or your tax optimization stuff, it's all still really boring. And you can still do that boring stuff by not really doing anything, but just checking a box in your employer application, and it's done on your behalf. And
easy.
That's all fine and dandy. But that's part of this barrier of entry. The fact that you get like animations on your phone that congratulate, like you got points in a video game, that's cool. That's like a reward system for empowering yourself in wanting to learn and cutting the veil a little bit. The Wall Street guys will use terms and they will hide behind the you don't understand, because these derivatives are extremely synthetic and exotic. And all that stuff is true. They're not lying necessarily, but they're almost trying to create their own little lingo and culture around it, saying, why don't you give us your money and you let the big boys take care of this? This is not for the children to play in. They're not saying that anymore, because these children cost them a lot of money, right?
Yeah.
It's clearly that there's a new group of people at the table, and they're collectively empowered themselves, saying, why are you talking about derivative 3x leverage cash flow? What? There's a button on my damn phone and I click it and then I make money, and that's all I care about. And that's all that you really should care about. Like I bring up this example last year in the pandemic when the quarantine started, everyone's locked up and work from home is going to be a thing. People flocked to the company, to Zoom, right? The teleconferencing. So like, that's going to be the new thing. I'm going to buy it, right? So the traditional Wall Street analysts sit there and go, well, that's clearly showing your immaturity, because just because more people are going to use something does not by any means make the company more profitable. They could potentially be operating in a unit economic loss. And so this is only going to accelerate the downfall. This logic is just backwards. So not only did they do that to mock these millennial investors, these millennial investors, turns out they bought the wrong company, because there was a ticker symbol for Zoom with ZM, and the correct company that was the correct company. And there was another company that had nothing to do with this, whose ticker symbol was the word Zoom, and they were buying the wrong Zoom. So not only did they not do the right type of analysis, they weren't even buying the right company. But guess what? That wrong company made them more money than they would have had they bought the correct one.
Oh,
right?
damn.
Because of the characteristics that the stock and how much attention it got, it spiked up well above what the actual Zoom did. So who had the last laugh in this situation? It's like, yeah, I had the wrong analysis, and yeah, I even had the wrong stock. But look at my P&L, dude. Go back to your Excel file and come back to me when you can beat these returns. And that's the kind of mentality that is different now.
That's awesome. I wonder how many other people were buying Zoom thinking it was ZOOM and it's ZM, and obviously benefit from that. So you brought up Robinhood, which it seemed like initially you were not a fan of it, and it seems like you're definitely more of a fan of it. It almost seems like you literally had a little boomer residue going on there, and now you've gone full Gen Z. You've gone boomer to millennial to Gen Z mentality. But beyond, so here's my question to you regarding Robinhood. So recently Warren Buffett and Charlie Munger did their annual shareholders meeting. I don't know if you saw, it just went down, and they weren't exactly fans of Robinhood. They kind of talked trash about them. Warren Buffett said, quote unquote, Robinhood has become a very significant part of the casino group that's joined the stock market in the last year and a half, to use your word. And then Charlie Munger, who's a handful of years senior to Warren Buffett, added, it's just god awful that something like that would draw investment from civilized men and decent citizens. It's deeply wrong. And they're talking about Robinhood, and you talked about Robinhood and the gamification and the low barrier to entry and the confetti and just hitting buttons. And obviously this completely culminated with what you founded, WallStreetBets, and the whole GameStop fiasco. So my question to you is, what are your thoughts on, is Buffett and Munger out of touch? Are the GameStop investors, roaring kitty, deep fucking value, just getting lucky? Is the answer somewhere in between? What are your thoughts?
I think it's easy to say that it's not that Warren Buffett and Munger are out of touch as much as they are resisting this change that is clearly ahead of them. But they don't necessarily have much to worry about. Their strategy is going to keep working. I think they're just annoyed about the fact that now you have more noise and there's more considerations that need to take place when making investments. Because now you really do, and I think hedge funds and investment banks, they really do need to factor in the social media component. Ask Melvin Capital about this, and they'll tell you how they feel about this as well. So now you have a new participant. Like, if you think of yourself, and before I make the analogy, I'll point out that Warren Buffett makes bad calls too, and he loses money too. He did so with airlines last year, and
he admitted to that.
We heard what he said about that, which is fine, right? Like, nobody faults him for being wrong. He's right more often than not. That's really what matters. But his methodology, it's been proven, it's systemic, that is stable for a very long time, is a proven method. So if you picture, for example, of Warren Buffett playing a poker table, where sometimes you lose money, like in airlines, but you have your mathematical approach where, like, I don't care about bluffers, I don't care about whatever. I know the pot odds, I know what I have in my hand, I know the number of players, and I know how much money's inside the thing. And therefore, mathematically, there is always a correct answer with poker if you want to just use math. And that's fine. And he does that, and he does that. But then if you've ever had a chance to go to a casino and you're playing with a bunch of people, and then you have a guy that either doesn't know what he's doing, or he's drunk and doesn't care what he's doing, or whatever, just feeling really like
running on pure emotion.
And then they start doing crazy things. They start bluffing when they should. They start betting odds, whatever, that sometimes they even make a mistake because they didn't realize they actually had the flush, and they were going for like a two pair. and it starts ruining your game because these guys start taking money for it. And all of a sudden you have to start questioning your little approach of saying, okay, well, the fact that there were 3 aces on the table and I have the 4th ace, and this guy's betting like he's got something that's even better than that. Like that does kind of interfere with his style. And I think that's just a resistance to change that is natural in life in general. And he doesn't like it because he's having to take into consideration this new market participant.
Well said. I think we got about maybe 10, 15 more minutes left. So I kind of want to touch on a few more topics. So let's circle back to WallStreetBets. So just going to kind of circle back there. So basically on the actual Reddit account, right, Jamie, it says it's like 4chan found a Bloomberg terminal, and it gives a disclaimer. It's not financial advice. This is a casino. You call your subscribers degenerates, like willfully and almost proudly. But you guys, so that's sort of like the joking side of things. But you guys do, ever since this GameStop fiasco, and I don't know how that's the best summary for it. If it's a fiasco, the hedge funds, GameStop, WallStreetBets, everything involved, you guys clearly have a commanding presence in the world of finance. People have called you, I think it was Chamath Palihapitiya, called WallStreetBets the largest hedge fund in the world now, which is ridiculous. You've been featured on Wall Street Journal, to take a name akin to you, Bloomberg, CNN, CNBC, Forbes, Business Insider. The freaking White House was talking about you guys. Congress was bringing you guys up. What's that all feel like? Does it feel like almost like you created this Frankenstein monster and now you're just kind of sitting back being like, have at it, world? What's that whirlwind of emotion actually feel like?
Look, I'll start just by clarifying something in case you get a lot of haters from this. All that is true, except that I was removed from WallStreetBets by Reddit last year. So over the past 12 or so months, I have not been a moderator on WallStreetBets. But the rest of the things that you said very much ring true. WallStreetBets it's the forum itself has a commanding presence, has a lot of followers to it, and they're definitely on everybody's radar, as you mentioned. But WallStreetBets as an idea and as an empowerment of people everywhere is spilling out all over the place. So you'll see offshoots of WallStreetBets where they'll change this. So Wall Street Silver or Satoshi Street Bets, for crypto stuff and other ones. And I think that this idea of empowerment, and it's what's propagated around the world, is the most unexpected, but also the most wonderful part about this. Like after GameStop took place, I got messages. I would say I got more messages from people outside of the US, from countries where they don't really have access to the stock market, their own stock market, where they don't have the ability to replicate or do anything. But that enthusiasm for saying, hey, I'm in the Netherlands or Spain or Korea. We want to do that here. In fact, there is now Korea Street Bets and India Street Bets, and they're all wanting to do that because that sense of empowerment is something that is powerful. It's something that the Occupy Wall Street movement failed to do. They're all sitting there with their picket signs that are saying 99% is not fair to 1%. Now all of a sudden the 99% say, okay, well, the pickets didn't seem to work. Now we're going to picket their pockets and see if that works. And that does, and it's completely forced comments like this from the Warren Buffetts of the world. It's forced. Politicians like it. Politicians are like, hell yeah, now it's their time to finally speak. Ted Cruz and AOC were retweeting each other about the fact that
like they're agreeing on something.
They're getting along all of a sudden, and
because of you, man, because of you.
And it's really cool. No, so I very, very much enjoyed the fact that people have been able to empower themselves with knowledge, with the ability to speak their voice in a different way than just voting. They can now vote with their wallets, right? Whether having to donate to super PACs or to donate to the local congressman, they can now vote with their wallets by saying, okay, I'm going to change these prices. I don't think short selling is a good idea, so we're going to show you how we feel about that, and end up costing these people money. So I think that is, I think that's a wonderful, wonderful thing. As far as for me personally, I'm enjoying watching it. Like the other than getting the attention and being able to have these great conversations with people, I haven't really had any personal gains. In fact, I had a really funny story. I was in Miami a couple of weeks ago, and I'm in a big shopping mall. And my brother-in-law calls me up and he says, "Oh, you're in the U.S. Hey, listen, I'm dying to get a hold of a PlayStation. Right? Like it's really hard to get a hold of. You think you can?" Like I'm on a tight schedule, and I'm kind of looking around. I'm like, "But maybe tomorrow." And as I'm doing this, I look up and I see a GameStop, and I'm like, "Hold on, I think I got this. I got an idea. I'll call you right back." So I go up to the GameStop and I walk past the store and I look into it and I see some little old lady like working the register, and that's it. So I'm like, no, she's not going to know what's up. I'll come back later. So I come back later and I see a guy that's a little younger, or much younger. He's like a young guy right there. I'm like, he's going to definitely know. As I'm walking in the store, I see these big signs that are plastered. It says, "We don't have any consoles. Don't even waste our time. Blah blah blah." And so I go up to this guy. I'm like, "Hey, I read the signs on the thing, and I know that you're not supposed to ask for these consoles, but I think my request might be special. Like, what if I told you that I founded WallStreetBets?" And I have my mask on, and he's got his mask on or whatever. Nobody can see each other. And he goes, "Oh, that's funny. Yeah, no, sorry, no consoles, dude." Like, no. Seriously, I really did start WallStreetBets. I can prove it. I have verified accounts on Twitter or on Instagram. I have a Twitter account, whatever it is. Like, just Google my name or whatever. It's like, dude, that's funny. Like, I've heard a lot of really good excuses, but this one takes the cake. I'm like, dude, I swear to God, it's me. Like, look, sorry, I muted my mouth there. So I say it's me, and he goes, "All right, let's say I believe you. I still don't, there's still nothing I can do." It's like, well, just think outside the box, man. Like, don't you have a manager or someone that can really use like the publicity? I'll plug you guys. I'll tweet whatever. Someone that's got decision-making power." He's like, "Yeah, no, sorry, dude. Take care." So not even that was I able to get with this.
Oh, dude, I thought that story was going in a different. I thought he had like the one magical PlayStation.
No, the personal benefits to me are none. The personal benefits to the world are wonderful, but as far as I'm concerned, not even a PlayStation.
You're a philanthropist in that regard.
There you go,
dude. That's like the perfect That's like the perfect investing joke where the founder of WallStreetBets walks into a GameStop, tries to get himself a PlayStation. Turns out he got hedge fund and he couldn't buy the dip, and he had to walk out the exit. Took a loss, but he's there for the greater good of humanity. I think that's got a certain je ne sais quoi to it. So that's cool, man. Quick rapid fire round, and then we'll wrap up. What do you say?
Yeah, that's good.
So, my show is all about personal finance. And obviously with speaking to you today, Jamie, we're covering different investing topics and asset allocation and everything goes along with that. But I have what I call the 6 principles of wealth, 6 strategies that, you don't need to be an expert. You don't need to take an economics class or economics degree. And you just kind of understand these things. So number 1, what are your thoughts on budgeting? Having a personal budget.
My thoughts are that you should have it. You definitely need to have a budget. You need to know what you can afford and not afford, and you have a plan, and you stick to the plan, and that's how you get to it. That's what you should do. I don't have the discipline for that, so I'd be a hypocrite if I told you that I practice those best practices.
Do you rent or buy, or when you're where you live? You rent or buy?
I've done both, but I just bought a condo. There's cost benefit to both of those. It's not necessarily the end of the world if you rent. There's a lot of good arguments towards renting, and I've leveraged those arguments. But right now, the benefits of owning in my particular situation and in my particular country far outweigh those of benefiting. So I'm switching over to ownership.
Especially when you have kids now, you said. When you're young and single, there's definitely advantages to renting. Thoughts on having debt, specifically consumer debt, credit card debt, car loans, that kind of a thing, the interest rate. What are your thoughts on consumer debt?
Yeah, consumer debt. I'm glad you made that distinction because debt isn't necessarily bad. But consumer debt, obviously, it's a bad thing. It's like a negative asset that just kind of sucks your money out. Like this idea of buy now, pay later, buy it over time or installments. There's times when that makes sense, but for the most part, there's times where you make sense where like I could pay for this right now, but I get 6 months, interest free on this particular thing, and it's debt because you owe it, but it's interest free, so it costs you whatever. You take that money and you can put it into whatever interest generating account during those 6 months. So there are examples where you can use debt to your favor. But if we're just talking about, I'm going to buy something and the money's not in my bank account, I'm going to swipe this card and I'm going to own this thing. It's a downward spiral and it feeds off itself.
What about the concept of saving or save that money, especially before you start investing? Save that money. What are your thoughts?
I don't draw a huge distinction between saving and investing. It's storage of value, so you can keep that into your savings account, your bank that gives you no interest or very little. Put it into a diversified portfolio, into an investment account. You can invest in real estate, you can invest in art. There's a lot of different things, and all those things are ways of storing your money. And those all go into one bucket. Saving, undoubtedly, unless you're a businesses can get away with spending, or they have to get away with spending without saving. That's because they have a different goal in mind and they have different tools. But as far as you or your family are concerned, you want to build that nest egg, because not only just the rainy day fund or when you're old, you don't have to work and stuff. Like, yeah, that makes sense. But what's the most powerful part of this is once you get a certain threshold, it's real discouraging to saying, I have $1,000, I put it into my bank account, I'm making 1% a year. That's never going to be Warren Buffett with this. So it's discouraging. But when you get to a certain level where you have $500,000 a year and you all of a sudden make 1% on that, that's $5,000, right? And now you have, without doing anything, and that's a really small yield or return. So once you get to a certain threshold, that money starts doing work for you, and you start feeling that financial freedom that people yearn, and you do it through no brainer, just savings.
Okay. When it comes to investing, let's say you could build your portfolio and you can only pick, talking asset allocation, you can only pick 3 different asset classes to invest in, right? Only 3. What would your portfolio look like?
I mean, the 60-40 is dead. The whole risk parity thing that I no longer, I would have answered that some time ago, but not anymore.
60-40 stocks, bonds, you mean?
Yeah.
Okay, so you're out on that. That's very boomer of you.
Very not boomer.
That's what I'm saying. That would have been very boomer of you.
Yeah.
Okay, so what are your 3 assets?
So I would go for, that's the thing though. For me personally, I'm in a position in my life where I'm risk hungry and I'm able to take that. So that context is super important. I do want higher yield and I can afford that risk at this point. So I will be putting in equities, I will be putting in crypto, and I will be putting in real estate. Gotcha.
So speaking of crypto, where are you long on? Where are you short on? Where are you like, I think Bitcoin, I think Ethereum, I think Coinbase is the future, and I'm short on Dogecoin or Mooncoin or whatever. Are you long or short on certain parts of the crypto space?
Look, I'm long Ethereum. Like that's the one that I like for a handful of reasons, and probably is where I have most of my assets. But I've recently gotten into this world, and there's a whole new class of crypto that's not a coin that I'm very bullish on. I got very involved with, right? And this is the ability to create these exchange traded product or portfolios on the crypto. So if you want to buy an ETP, right? Like this thing where you buy and it's like a stock, and that thing has a little bit of equities, a little bit of real estate, a little bit of metals, and a little bit of commodities. This thing collateralizes these things, puts it on the blockchain, and now you're owning a stock. And then you can have Korean stocks, you can have whatever it is you have. And so now we're mixing both worlds, all in a decentralized fashion. I am insanely bullish of this idea because it's going to fix all the inefficiencies in Wall Street and Main Street. So which coin do I like? Ethereum. Which technology I like? These decentralized organizations and exchanges that are going to really take this democratization of finance to a ridiculously next level.
So is that like an ETF, but with multiple asset classes, crypto being one of them? Is that kind of what that is?
It's exactly right. It's like an ETF where you buy the equivalent of a share and it's in your account, and that ETF is collateralized, meaning behind the scenes, someone went out there and actually bought the underlying stuff. And in these ETFs or ETPs that are in the crypto space, you're going to have crypto if you want to. You don't have to. You can have different ETPs. One that is completely against crypto, one is completely for crypto, or one is a boomer ETP where it's just copying Warren Buffett. But the cool thing about the technology allows you to pull from all asset classes, not just U.S. equities, but global equities.
Cool.
And allow that to be at the hands of everyone. So if I want to buy Samsung, which I currently cannot because it's hard for me to trade in Korea, I can do that through this coin. And then this coin magically goes out and actually buys this stock to collateralize this particular token. And you put equities, you can put crypto in there, and you can put metals, you can put bonds in there, you can put real estate in there, you can put derivatives, and you can go as crazy or not crazy as you want with these things. So I'm really bullish of that.
The next time we talk, I'm going to definitely follow up on these ETPs. I like the sound. And what does it stand for, ETP?
ETP is Exchange Traded Portfolio.
Portfolio.
The one that we just launched is called the WSB DApp, like DAPP, WSBDApp.com. And that's where it's the first of its kind where we're doing this. The what do you call it? Examples of this, like the proof of concept already works. You can already buy Tesla shares on crypto.
Okay.
Where they do basically collateralize that share, and they've already done little bits and pieces, but we're the first ones to put it together, and we're putting a WallStreetBets twist on it, where the community decides what goes into each of these ETPs. You have the YOLO ETP with crazy stuff. You can have your Boomer ETP with not crazy stuff, and it's great.
That's awesome, man. All right, so last question, and you touched on this when you were talking about investing and getting to financial freedom. So here's my question, Jamie. Back in the day, used to, boomers or, the parents of boomers, if you will, the greatest generation, silent generation, they would have retirement. And, their definition of retirement was working all your life and finally have enough money to just sit back on a beach in your rocking chair and you're retired. There it was. And I think everything today, retirement is definitely being turned on its head. People are living longer. You need more money. Nobody just retires and does nothing, certainly not successful people. So my term for retirement is called chilling. Right? When you're chilling and you got money in the bank, you can do what you want to do. You can travel. You can work on what you want to work on. You can donate your time. You can pursue a passion, help people. Jamie, what is your chilling?
What is my personal vision of my chilling retirement?
Yeah.
Or what are you thinking? The same exact thing. And that's exactly what I was going to say. Yeah, sure. Like when you can stop working, that's a thing. But I don't know anyone that's ever stopped working. Like Bill Gates, he works on giving away his money, but it's a job for him.
Full-time job.
And he loves it and he chills doing it. And that's what's great. Like, and you said it correctly. Longer life expectancy or less money, whatever, it'll take longer for you to be able to stop your job or whatever. But I've also know a lot of people, a lot more than I think the previous generations did, that are currently in their 20s and 30s and 40s chilling. And they're busy, they're doing stuff, right? Like they're constantly on the lookout for next projects of influence of improving the world, but having to worry about paying the bills is not one of them. That's how I'm at, that's how I am right now. And I am working on the most exciting stuff because it's the stuff that I love. Like this thing I just mentioned, do a competitive day trading, an entire event out of this thing and a reality series TV, like I'm doing a podcast. So I get to have fun doing what I love and generating money as a side, is a bonus of it. But if it doesn't generate that money, then I'm fine too.
Well said, man. Well, I look forward to having a round two with you the next time you're in Miami and literally maybe having a round of drinks with you as well. Jamie, thank you for being a guest on Valuetainment.
Thank you so much. I had a really good time.
All we talk is money. All we talk is money. All we talk is money. All we talk is money.